Hi, I'm Chris from Stockspot, and as we're in a federal election year, we've reached out to both major political parties to speak to them before the election to get a better understanding of their policies and where they stand on superannuation and financial advice. Now, Stockspot doesn't endorse any political party. Rather, we want to speak to all parties to understand, their policies to help you, our clients, and viewers get a better understanding of where they stand and how their policies might affect your lives in the future. Now today I have the pleasure of speaking with the Liberal Senator, Senator Jane Hume. Senator Hume is from the government and is the Minister for Superannuation, Financial Services and the Digital Economy, as well as for Women's Economic Security. Senator Hume was elected to the Senate for Victoria in 2016 and was re-elected in 2019. Senator Hume, thanks very much for taking the time to speak with me today.
It's great to be with you.
Now, since you've joined Parliament, there's been a lot happening in your portfolio, particularly around financial advice, superannuation, and also big changes in digital currencies. I wanted to start, first of all, on financial advice. There's been a bit of news out recently talking about the changes in the financial advice industry and that there's been a lot of advisors leaving the industry over the last few years. I think the stats show there was something like 13% of Australians getting advice from a traditional professional financial advisor in 2018. It's about 10% today. And advisors are leaving the industry from what we hear, and also the cost of advice is gradually creeping up. Are there areas that you think more Australians should be getting professional financial advice, and what areas do you think they are?
Yeah, Chris, this is an area that I'm very passionate about. In fact, I started my professional career in financial services on the financial advice side back in the 1990s, giving away my age here, but back in the 1990s when it really was a very different industry. It really grew out of insurance sales. And then it really flourished when compulsory super came in the early 1990s. And it was so complicated back then that people needed help to navigate their way through the system. But it was still very much a sales profession. In the last 20 years, and particularly the last decade, we've seen a massive shift from that sales profession, that sales mentality, through to it becoming a proper profession, rather than a sales job, a proper profession, where the interests of the client come before the interests of the advisor. Now, that's been a really uncomfortable shift for a lot of people, making things like a best interest duty or at an educational standards that people have to meet. So we kind of knew that people were going to leave the industry if they didn't want to come along on that journey. But I think that the worst is over now and the industry has settled in. On top of that, we've had this massive digital disruption, and the compliance sort of component of advice is becoming more and more onerous at the same time that digital solutions are coming in. Finding the right mix of digital solutions as well as that personal advice is really important. But I think that we're getting there now. We have a quality of advice review that's going on as we speak. Michelle Levy is running that review, and that's looking at not just the quality of advice, which was a recommendation of the Hume Royal Commission, but also affordability and accessibility of advice, making sure that any Australian that needs advice can access it in a way that they can afford and in the the amount that they need. Not everybody needs a full financial plan on day one. Sometimes they just need bite-sized pieces of advice on the way through. And certainly digital advice can fill that void.
And do you think, it's a combination of these traditional advisors leveraging these digital services, or sometimes, separately using an advisor that's a traditional advisor versus a digital advisor? What sort of trends are you sort of seeing emerge out of that?
Well, I think there's a combination of it all. Digital solutions can really help reduce the compliance burden for traditional advisors. That reduces the cost of a financial plan. But also for those, there is a digital solution for those people that might not necessarily need the full advice. There should be something out there for them too. So it's about making sure more people have access to advice. It's not about eating in to traditional advisors, client base. It's about making that traditional advisor's client base have access to cheaper advice.
Yeah, and I think, that's what we're seeing certainly on the investment space. The ability to give scoped advice is really changing the industry quite a lot.
It's been interesting, in the last 20 years, one of the phenomena that we've seen but not spoken about is the fact that financial products have come right down in cost. When I was working in financial advice in the turn of the century, gosh, that makes me sound old, but the turn of the century, we were looking at products that had 5% upfront commissions or 0.5% trailing commissions, 2% MERs. That was really expensive, but because the cost was built into the product, people didn't feel it quite so badly. They're just that their returns were reduced. Well, now the returns are higher, the costs of the product are lower, but the cost of advice is higher, which means that financial advisors have to demonstrate the value that they offer to their clients. Sometimes that can be an uncomfortable conversation, but it's a really important one because we know that advised clients tend to make better decisions, particularly in periods of volatility and uncertainty.
Yeah, I agree. And I think, we've seen definitely the transparency has been improving over the last few years. Definitely from speaking to some of our clients, they weren't aware about some of these commissions, but now knowing what they're paying makes them feel a lot more comfortable to get advice.
Well, that's right. Banning commissions, I think, was a really important part of the journey, taking that job from a sales job to a profession.
Exactly. Now, I think one of the groups of people that have started to fill this gap on advice, particularly after the big market collapse of early 2020, is finfluencers. So there's been a big group of, generally younger people online providing tips and guidance about, personal financial planning matters, but also more generally just, making sure you're in good financial health. What are your thoughts on the role of these influencers in the future of financial advice?
Well, I love the fact that young people are engaging more with their personal finances, whether it be how to manage budgets, do a basic budget, how to open a superannuation fund, how to, get their tax file number sorted when they get their first job, or even something like, managing debt and making sure they don't fall into any of those debt traps or scam traps. That's really important and a great service. But at the same time, there's a fine line between finfluencers and financial advice. Certainly, ASIC have come down really hard on finfluencers. They've gone on they're leaning towards the more cautious side, saying that, look, this is financial advice, particularly if they accept commissions or financial or any sort of gain for promoting a particular product or service. And rightly so, but at the same time, I think that people have been offering free financial advice, or not financial advice, but free tips for forever and a day. It used to be in the 1930s, what was it that they said that when the bellboys start giving you stock tips, it's time to exit the stock? Taxi drivers, whoever it might be. There's been lots of advice out there from friends, family and strangers for forever and a day. And I think most Australians are sensible enough to be able to distinguish between financial advice and a tip from a stranger.
And do you think consumers understand the difference between getting a tip from your Uber driver, which I think probably still happens these days, versus someone online who, that they may not know, as you've sort of mentioned, whether they are financially incentivized from the product they're talking about? Where do you think the regulation needs to sit to make that sort of transparency apparent to consumers?
Well, that's ASIC's responsibility, and they've done a very good job on that. And ASIC are independent of government for a very good reason. That's so that politicians don't make that distinction. But at the same time, I think that most Australians are sensible, as long as there are the right disclosures that are made. Then I think that there's some really good work that finfluencers do, engaging young people. But there is a fine line, and we don't want it crossed.
Yeah, and on that fine line, so one of the interesting parts of the Royal Commission recommendations, the Hayne Royal Commission, I thought, was that he didn't explicitly say that there needs to be a ban on vertical integration, that relationship between financial product manufacturers and actually the advice providers. How do you sort of feel about that sort of going forward? Are you comfortable that it will ensure consumers can access, best interest advice, despite relationships between, products and advice providers, and what needs to be done to ensure consumers keep on getting great advice?
Yeah, Hayne, you're right. He didn't explicitly ban vertical integration. It just seemed to happen that way on its own, which is a good thing. I think it's something to keep an eye on, but I don't necessarily think it's something that government needs to legislate for right now. The Hayne Royal Commission was a real shake-up to the financial services sector more broadly. I think that people have looked at financial services with very fresh eyes, and certainly the government has responded in a very comprehensive way to the recommendations that Hayne made to make sure that there's no more hawking, that products are marketed appropriately to people, that there's a target audience for a particular market, those design and distribution obligations. So I think people are far more cautious now in the way that they distribute products than they ever have been before.
And do you think, it seems like you're right, a lot of the banks have now sold their, vertically integrated models, or there's been big changes. There have been a few that have hung on and said, look, we believe there's still a good place for this. In some part of the market cycle, it seems like this is never sort of apparent. And then when everything falls apart, I guess bad advice becomes more apparent. Do you have concerns through the market cycle around this sort of thing? That bad advice will rear its head again when times are tougher, or do you think we've now set the right structure to prevent it in the future?
I think that there's appropriate regulation now of the financial advice sector in a way that we potentially haven't seen before. There's also new obligations that are on financial advisors themselves, as well as the dealer groups, to make sure that there is a higher standard. We know that the educational standards of financial advisors is much higher now. So I think the chances of poor advice is far less than it used to be. That said, there will always be people that lose money because investments are inherently risky. You invest to make a return, but there is always a risk involved, and that's something that people should have to understand. And governments aren't there necessarily to stop people taking risks. In fact, we want people to take a risk and create wealth and build wealth for their families and build opportunities for themselves and for their families. But at the same time, we just have to make sure that it's done so in a way that you can trust the financial advice that you're getting.
Now I want to move a little onto super now. So, one of the big reforms that the government's brought in is the Your Super, Your Future reforms. And one of the big parts of that is this super performance test, which is basically, created to, improve transparency and also help consumers become aware of underperforming funds through more transparency, as well as consequences for funds that aren't performing well. From what the government's seen, what impact has the performance test had so far?
Yeah, well, the performance test is only one part of the Your Future, Your Super reforms, which are estimated to save Australians around $17.9 billion over the next decade, straight back into their retirement savings, which is terrific news. But the performance test essentially it was a bright line test, and it said to super funds, if you can't meet that bright line test, which was 50 basis points below your own benchmark over a rolling 8-year period, well then you should rethink your position in the industry. You have to write to your members and say, hey, what was written on the box wasn't what we delivered, and then your members can make up their mind as to what it is that they want to do. If you fail 2 years in a row, well, then you're not allowed to accept new members into your default fund. So it's a pretty big stick that we're carrying there. And of the 81 MySuper products, there were 13 that were identified as underperformers. One of those has already exited the industry. 9 have found merger partners. There's still a remaining couple that are under heightened observation by APRA, the regulator. So there has been quite a significant shift. Around 100,000 accounts were shut out of underperforming funds and moved on. And of course, those ones that have merged are merging to better performing funds. So it has made a significant difference in a very short space of time. And this is, those letters went out in, I think it was September last year. In just 6 months, it's made a significant difference to the retirement outcomes of thousands and thousands of Australians. But most importantly, it's not the only part of the Your Future, Your Super reforms. There's now also heightened transparency. There's an online tool on the ATO's website where you can compare your super fund to other super funds that are out there on the basis of performance and fees. So you get a sense of where your fund is in the rankings. And that's never been around before. You've never been able to compare apples with apples before. And most importantly, we've also applied a best financial interest duty to trustees. So before, trustees had a best interest duty, but that had sort of become a bit of a nebulous concept over time. And by focusing trustees' mind on their best financial interest of members, when they make a decision, whether it be an investment decision or a marketing decision, do they sponsor a football team, for instance, you have to say, well, is that decision in the best interest of my members? You have to remember that superannuation funds are held in a trust structure, so the only money they've got is your money. They can't borrow, they can't raise money on markets, on capital markets. The only money they've got is yours. So when they make those decisions, it's your money that they're spending, and that's why it's important for trustees to say, is this in the best financial interest of my members?
I want to get back onto the trustee point in a moment, but I think you've made an interesting point that now they have to make decisions really considering the financial interest of members. From what I've read from some of these funds in the past, one of the justifications for doing big marketing campaigns, sponsoring football teams or stadiums, was that drives scale, and that scale allows them to reduce costs for current members. Is this something that we're seeing? Does the scale really reduce costs, and therefore are these big marketing campaigns justified for these super funds?
Well, this is the thing. Now trustees have to demonstrate that they've done the work to show that if they increase scale through these marketing campaigns, that it will in fact reduce costs for members, or at least provide a financial benefit for members. I know we've seen a lot of consolidation of superannuation funds in the last couple of years. Some of them are now becoming very large indeed. But we want to make sure that we see appropriate cost reductions, fee reductions come as a result of those of the increase in scale.
And the performance test seems to be doing a good job from what you've described at really weeding out some of the real duds in the industry, or at least making consumers more aware of them and bringing in harsher penalties. What about all the funds in the middle that are managing to pass the performance test, but still, are wasting consumer money, or, are too bloated and could be saving consumers more money? What incentives do these sort of funds have to improve?
Well, they still have APRA oversight. So, the performance test doesn't change that. APRA still can see what's going on in all superannuation funds. And on top of that, we've brought in portfolio holdings disclosures now. So all super funds have to be entirely transparent about the assets that they hold. So if you want to do some forensic investigation of what your super fund is actually invested in, you can now do that. All of that information is available for the first time, which essentially puts superannuation trustees on notice that they can't hide things within superannuation, a data investment or a related party transaction, for instance. It can't be hidden somewhere in those in the performance data.
And do you think, we do this annual super fund research trying to really understand the nitty gritty, and we have a few analysts that do a month worth of data collecting from all of the direct funds websites to get all the information, something we find quite hard to do ourselves. So we can only imagine that it's quite difficult for consumers is compare like funds on a like for like risk basis, and then actually deep dive into the underlying investments and work out which managers is this money going to, how much has been invested with each manager, is each manager outperforming, is this the sort of information you expect should become more available?
It's there now. I think we've just done your job for you. So, Stockspot should be saying, thank you very much, Coalition
So
government.
should we find, for any fund we're looking at, should we be able to see how much money they have invested with a certain active manager and how that manager themselves has performed?
Well, a level of detail in those portfolio holdings disclosures is something beyond which we've ever seen before. So I think that you'll find now that your job is much easier, and it is much easier, more importantly, for the consumer if they want to see whether, for instance, their fund is exposed to a particular company or a particular asset class that they might not be comfortable with.
And what about the valuation of these assets? So we know there's a lot of super fund assets that are traded on listed markets where the valuations are quite clear every day, and obviously markets move up and down and sometimes they go extreme, but at least people have some sort of idea. There's been a lot more money invested recently in unlisted assets, yes, where the valuations are determined periodically, and based on formulas that most consumers and even most industry professionals aren't aware of. How do consumers get comfort that these assets are being valued correctly?
Well, again, the portfolio holdings disclosures regime should help those people that want to see how those unlisted assets are valued. You know, we saw that particularly in 2020 when we had that massive economic shock because of COVID, and there was a revaluation of a lot of unlisted assets that was quite dramatic. And there was some rather murky behaviour, if you like, that we saw coming out of some of the superannuation funds, of them switching between asset classes.
And even the executives of some super funds.
Exactly right, and trustees too, which was, you know, a rather unedifying behaviour. Now, it wasn't, according to ASIC, insider trading, but it had a lot of similarities to that kind of behaviour. Portfolio holdings disclosure regime will allow you to be able to see what those revaluations were and are, which I think is really important for average consumers, just so that they get a sense that somebody is watching, you know, that there is some oversight of what's going on you know, behind the curtain of the superannuation funds.
Yeah, I mean, there definitely seemed like there was a bit of a lag during that March-April period, because we were tracking the unit prices of some of these unlisted infrastructure funds and property funds, and they weren't getting marked down, and the listed markets were down 30 or 40 or 50%. So it did seem like there was a bit of a gap, and it did eventually close. But yeah, I worry about people with inside information, like you've mentioned, or just consumers making a run on these super funds if they realise that the values haven't been marked down yet. But maybe in the future, do you see a structural risk there where there may be a run on a fund one day?
I think that it's something that the regulators now have increased a heightened awareness of, and they will change their oversight practices to accommodate, because it is really important. What it means is that insiders, or those highly engaged investors, will take advantage at the expense of those that aren't engaged, the mums and dads investors. You know, people that are in a default balance fund might end up paying for the highly engaged decisions of somebody that's just in single asset classes, and that's not good. You can't use a default fund or a balance fund as essentially the cash deposit for making those sorts of investment decisions. So I think that there is a new awareness of that now, and the regulators are all over it.
And so these unlisted assets are really on one extreme of very actively managed, and these sort of real asset funds. On the other extreme are index funds, and something that sort of surprised me for many years and our business is that more super funds aren't having a larger proportion of their assets indexed. Now, I think the performance test may go to change this a little bit, but has it surprised you that compared to other countries where you've obviously understood their pension systems, where a big proportion is indexed? And a great example I always cite is in the Nevada State Pension Fund, is one of the best performing pension funds in the US, has one employee, and all of the money is in index funds. It doesn't seem to happen in Australia. Do you have a feeling of why that is, and why so much isn't indexed?
That's funny. I think we have a culture in Australia of active investment, and have done for some time, whereas perhaps that wasn't the same in other jurisdictions. But it's increasingly so, and with the entrance of ETFs, I think have been a big eye opener for a lot of people. The value that you can gain from investing in ETFs. So and with the entrance of something, say Vanguard, for instance, when they come into the market with their index offering, that's going to shake things up a little bit too. So I think a combination of the two is probably something that Australians feel comfortable with. Certainly something that regulators feel comfortable with. But it's really horses for courses, isn't it? It's not for government to tell you how to invest. But I'm really glad to see the introduction of index funds and the comfort that people are getting from investing in index. And
it sounds like you're comfortable generally that the costs are coming down regardless of whether it's actively invested or invested in indexes.
Well, that's right, and we have seen costs come down significantly, particularly in those default funds. They've come down by around 30% just in the last few years alone, which is really good news for superannuation investors. They might want to make sure that they're getting value for money, because they work hard for those retirement savings, so we want to make sure that their retirement savings are working hard for them.
Now on super, there's been a bit of discussion recently around some of these larger super funds actually raising funds from members as a trustee reserve. And the idea that some trustees in Australia are very well capitalised and some are not well capitalised, and they need to be better capitalised. What's your thoughts on trustees using member funds to capitalise themselves?
This one bothers me a great deal, actually, because essentially what it's saying is that the trustees are going to take money from the members to pay for penalties for the trustees' own misconduct. Now, that doesn't sit comfortably with me at all. The trustees themselves often have the backing of very large organisations, employer groups and unions, or other financial institutions, and they've got plenty of money to pay penalties for their own bad behaviour. I don't think they need to take the retirement savings out of people that have trusted them to manage their money in order to pay for those penalties. So this is something that we're going to keep an eye on in the future.
And is your stance sort of different to the operating risk reserve, which traditionally has come out of the members, that you're thinking for the trustees, it should be brought in, externally, not from the members?
Well, that's right. I mean, essentially carving out members' money and putting it in the hands of trustees to pay for their own misconduct. Let's be very clear what it is that they're doing. This is only if they get penalised for their misconduct. That just doesn't sit very comfortably with me. So, I think I've made that position pretty clear as publicly as I possibly can, and now it's up to the regulators to manage those decisions.
And in the next term, if you get into government, will there be more that you do in this space?
I would hope that we wouldn't have to get to a stage where we need to legislate to stop this behaviour, but certainly it goes against everything that we have been reforming, the direction of the reforms that we've been taking superannuation in the last 3 years. The best financial interest duty should hold trustees to a much higher account, which is terrific. Portfolio holdings disclosures means that superannuation funds are far more transparent now than they ever have been before. But trustees need to be held accountable for their own misconduct and not at the cost or the expense of the super member.
And one last question I have on super, and more of a personal question. So you've obviously worked in the super industry for a good part of your career, and now are in the ministry on superannuation. If you could speak to your younger self about, what you would be doing with super as a, younger version of yourself, and what advice would you be giving, yourself and for our viewers and our clients, what would you be saying to people, about their superannuation?
Well, look, when I was younger, and it didn't exist when I was younger, but I wish it had, catch-up contributions, I think are one of the most important reforms that this government has made, allowing people to take advantage of the full concessional cap of $25,000, now $27,500 each and every year is fantastic. And be able to roll that forward for unused proportions of that cap in previous years is such an opportunity, particularly for young women, ones that have taken time out of the workforce to look after kids, or older women that have taken time out to look after elderly parents, people that have worked part-time, people that have spent a period of time unemployed or travelling. This is an amazing opportunity to bolster your retirement savings by using flexibility measures. And while that didn't exist when I was younger, I wish it had, because I would have used it when I was raising my kids.
And do you think, so that's individuals catching up, I guess, using their own contributions. Do you think like employers or the government could be doing more, let's say for women that are out of the workforce, having kids to help them catch up? Is there more that could be done, or are we doing the right amount?
I think employers are actually doing that now. One of the benefits of having such a low unemployment rate as we have at the moment, 4%, and edging towards things with something with a 3 in front of it, and even lower for women, which is fantastic. One of the benefits of that is that employers are now rethinking about how they attract and retain the best staff. So they are offering incentives to keep their female employees, particularly while they're taking time out on maternity leave, and that's a really good thing.
And do you think that's been one of the drivers? A lot of discussion in super is around the gap between males and females and their super balances. Has that been one of the contributing factors? The fact that one, I guess, is that women generally have been paid less in the workforce, but then the time that they've spent out of the workforce, they've been missing out on super contributions.
Yeah, it's funny, we talk about, and this is part of my other portfolio, Women's Economic Security portfolio. We talk about how the best decisions are made, particularly around policy or business decisions, are made when there's diverse voices around the table, and particularly women's voices as well. Well, clearly superannuation was made without a single woman's voice around the table, because it really was never set up to work for women the way it works for men. It will always be a reflection of your working life. So if you have a gender pay gap, if you take time out from the workforce, if you work part-time, whatever it might be, if your participation rates are lower, well then your superannuation balance is going to be lower. But it's really important, I think, for women to understand that while your superannuation balance is really important, it's actually your income in retirement that determines your standard of living. And being able to effectively use savings outside of superannuation as well as the age pension in conjunction with superannuation and blending the three together in the most effective way, that's how you raise your standard of living in retirement. And in fact, that was really the thinking around the Retirement Income Review, which was a review undertaken by this government, a very significant and comprehensive review into our retirement income system. And it's the first time we've done that since compulsory superannuation began. So that was very helpful and will inform policy making, I think, for decades to come.
And so do you see that gap closing completely over the next 10 years, or will it take a lot longer?
I would love to see it close completely over the next 10 years, but you know, superannuation has a 40-year grandmothering trail, I should say, shouldn't I, if we're going to be entirely gender neutral about it. So it will be very hard to close it entirely, but we're already seeing, because of the increased women's workforce participation and the significant lowering of the gender pay gap that we've seen under this government, down from around 19% when under Labor down to around 13.4% now, we're already beginning to see that gender super gap close, which is really encouraging news. Now there's more to do, certainly, particularly I think for those women that didn't grow up with compulsory superannuation. They're the ones that, those women over 50 are the ones that are really struggling now. But there are more opportunities now through things like catch-up contributions, through opportunities to do non-concessional contributions and bring forward those contributions, through the downsizer from your family home into a smaller house, being able to put that money into superannuation. So there's more opportunities now to put money into super when you're able to, when you're capable of doing so. And I think that's something that should be encouraged. And property you mentioned, so there are some, I believe, Liberal senators as well that have floated the idea of using your super to buy a house. So, I mean, what's your thoughts on that concept? Look, I'm in two minds about that one, quite frankly. It's not government policy, I should make that very clear. What we have introduced, though, is the First Home Super Saver Scheme, which allows people to save for a deposit within superannuation, within that tax-effective environment, and that allows people to turbocharge their savings for the deposit for their first home. And there's thousands of people that have taken up. I think it's around 28,000 or so people that have already taken up the opportunity to do that, which is really encouraging. Superannuation is there for retirement savings, and that's a really important distinction to make. There are other ways that we've helped people into housing through things like the First Home, not just the First Home Super Saver Scheme, but the First Home Guarantee, the Family Home Guarantee, and that's now been expanded out to 50,000 people every year can now take advantage of these government offers to get into a home with as little as a 5% or even 2% deposit if you're from a single parent family. So.
And is it, having only a 5 or 2% deposit, it means you've got a lot of leverage to the property prices going up, but also down. Is that a sensible decision to buy a home if you've only got a 2% deposit?
Well, there are certain parameters around how much you can borrow and how expensive the house can be, but most importantly, the banks still do a full credit check. A lot of these people are fantastically creditworthy. They simply haven't managed to get the deposit together. And let's face it, if you're saving $1.10 of everything you're earning for your retirement savings, it makes it that bit harder to save for your deposit too. And that's what these programs do. Acknowledge the fact that you're putting your money away already in superannuation, which is terrific for your retirement, but we want to help you out a little bit with your deposit. You're creditworthy, but it's just harder to get that 20% together before you can take that first leap into the property market.
And the First Home Saver Scheme, like I've seen over the last year or so, house prices increased substantially in Sydney, and I'm sure you've seen the same in Victoria. Should that scheme be increased to reflect the house price changes we've seen over the last few years?
Well, the caps potentially, I think they actually already have been changed in this budget to reflect that the housing market has gone up. The most important thing, of course, with housing is to ensure supply, and that's why we really need to encourage the state governments and local governments to release the land so that we can increase housing supply, and that will take the heat out of the housing market.
So I wanted to move a little bit out of super to one of your other portfolios, which is the digital economy. There's a lot of interest at the moment in cryptocurrency, decentralized finance. We hear our clients talking about it all the time, and there's a whole bunch of startups, in this space in Sydney and all around Australia. Now, I think in a speech recently, you said, and I don't want to misquote you, don't be the person in 1995 who said the internet was a place for geeks and criminals and would never become mainstream. Now, obviously, the internet, there was a lot of skeptics originally, and it's proven itself. But a lot of internet companies, I guess, listed in those early days were listed on stock exchanges, were regulated. There was a certain level of rigor that went into, investing in one of those. It seems from our perspective that cryptocurrency and DeFi is, a lot more open and isn't regulated at all. What is the right level of consumer protections for cryptocurrency and decentralized finance?
I think this is one of the most fascinating developments in financial services more broadly that we've seen in decades. And, I know there's a lot of skeptics out there, but crypto is here to stay, and particularly the technology that lies underneath crypto, the blockchain technology. There are so many use cases for it that we haven't even yet begun to explore. So I'll always be on the side of innovation. One of the things that I most like about cryptocurrency investors is that if they lose money, they don't come to the government and say, what are you going to do about it? They are consciously taking a risk when they invest in cryptocurrency, and sometimes they win and sometimes they lose. But it's their responsibility, and they know that when they make that investment. Now, we have to make sure that, because crypto
Does that mean
itself,
someone with a cryptocurrency loss on their tax return shouldn't be eligible for government support?
Well, this is a nice question. This is actually one of the most important issues. We can see when people, the on-ramps and the off-ramps of cryptocurrency. Cryptocurrency is not a tax avoidance measure, and I think that people that invest in crypto might think that they're sort of flying under the radar. They're not flying under the radar. Crypto itself is in fact sort of trustless, it's permissionless, and in itself is actually quite a safe investment, if you like. It's the framework around it where the risks are, and particularly when you put in those third-party providers, those intermediaries, things like exchanges or custodian services or brokers. So what we've said is that's who we will regulate, the third-party providers around cryptocurrency, and we'll provide them with essentially a very Australian tick of approval so that you know that if you invest in cryptocurrency via one of those exchanges or using those brokers or using those custodial services, that you are actually getting what it is that what's written on the box is what you're getting.
And how does the government get comfort around that? Because I would guess that there's all sorts of different risks with custody of digital assets that are hard to actually identify.
That's right. So there has to be some maybe capital adequacy requirements, a fit and proper persons test, all of those sorts of things that you would expect in an Australian financial services environment. But it's important to know that crypto isn't always a financial product and shouldn't be regulated as a one-size-fits-all approach. But by making sure that those exchanges are there's appropriate oversight of them, I think that it will take us a long way towards cryptocurrency becoming more mainstream, people more comfortable with investing in a safer environment, and fewer scams too. You know that if you get called up, for instance, by somebody saying, "Hey, you want to invest in crypto?" Well, that's not approved. That's hawking, and there would be anti-hawking provisions and things. And
are you talking about future legislation, or is this already?
We put a discussion paper out there, and there's a lot of people that are giving us some feedback on it. But it's been met exceptionally well by the industry, who are looking for that level of certainty. Around 17% of Australians already invest in cryptocurrency. It's an enormous amount, and for that reason alone, we want to make sure that this is an opportunity for Australians to invest, but in a safe environment. We're never going to guarantee you're going to make money out of cryptocurrency. That's not government's responsibility. But we want to make sure that innovation is something that can thrive and flourish here in Australia.
And I think, you've made a great point that it's been an area that people are aware of the risk and return. And we've been through 10 years now where, Bitcoin's gone from an investment that was $100, now to one that's, something like 50,000 Australian dollars. So, there seems like there's a lot of FOMO around and people want to get involved. How do we ensure that people are investing the right amount? I know in other areas that the government's put out policy like equity crowdfunding, there's limits to what retail investors are allowed to invest in these areas. When cryptocurrency ETFs are available, which it sounds like it's going to be in the next few weeks, it will make cryptocurrency a lot more accessible, what needs to be done around either education or policy to prevent people from losing a lot? Because we know that even Amazon, a great company now that's made people a lot of money, its share price fell 96% in 2001, and a lot of people didn't hang on during that tough time. If people are going to benefit, how do we ensure they're long-term investors?
Well, look, the government's never going to tell you to, not put it all on red. Some people will do that, and on their head be it. At the same time, we want to make sure that those people that are investing sensibly can do so in a safe and regulated environment. It's interesting how crypto has become part of the mainstream in that, some super funds are now looking at including it as part of their portfolios. I think the most important thing is that we ensure that there's a level of education whether it be with young people, whether it be with other cohorts, so they understand that there are risks, and there are always risks that come with those sorts of rewards.
Mm-hmm. And I know, so this isn't specifically in your portfolio, but there's been a lot of discussion around the skill shortage in Australia, and we've certainly seen it within our business. Hiring, particularly on the technology and engineering side, has only got harder, since 2020 and all the lockdowns. What do you think should be done, or what is the government going to be planning to do to make sure that we've got enough skills to fill these gaps in cryptocurrency and all of these interesting emerging technologies?
Well, actually, it's tech more broadly that we need to get the skill sets here, and part of the digital economy strategy is building skill sets in things like not just blockchain technology, but also Internet of Things, in cybersecurity, in AI, in advanced data analytics, and of course in quantum computing too, which was a big part of the AUKUS agreement. So we've started working with the Tech Council, for instance, to sort of increase tech skills in Australia. We've also got some very specialist training, whether it be at TAFE level or whether it be at university level, in all of those areas. And we're using the $1 billion Job Trainer Fund, which provides low fee or no fee training in areas of need to really leverage some of the changes that we need in the tech space, which is really exciting, I think, because there's so many applications for all of those technologies in things like small business, but also in traditional industries like construction and mining and agriculture. You think of drone technology flying over agricultural properties, or digital twins in construction, or driverless vehicles on the Pilbara. All of this stuff is such an incredible opportunity for Australia to take that next great productivity leap. But also new industries like Fintech, for instance, RegTech, MedTech, games industry. This is stuff that we can be really good at here. We have the skill sets, we have the right regulatory environment. So that's exactly what we're trying to do, trying to make sure that we've got the skills that we're building here, right here in Australia, in order to make those industries thrive and flourish.
I think, we need probably a different thing to the future, in that I see a lot of younger people now starting engineering degrees, and there does seem like there's a big push there and a lot more interest. The problem is I can't hire anyone that's starting a job right now today. And so I guess it's a balance between, building those skills for 10 years' time, as well as allowing people to come from overseas and encouraging people to come to be able to work here.
But it's also people in existing industries. It might be, people that are in banking, or people that have been in compliance or administration of some sort, that don't need all that much to upskill in such a way that they can work in a tech industry or the tech space. And there's a lot of really good organisations that are out there right now, and the government is supporting them to help people make that transition from traditional industries to something that is more high tech.
And maybe some of these financial advisors that are leaving the industry, that can be the future.
But they're better, and they're higher paying jobs, they're in high demand. They really are the way of the future. It's funny, in 2016, in the election back then, when I was first elected, one of the slogans that we went to the election with was we wanted a more innovative and agile economy. But back then, people just heard, oh gosh, I'm a forklift driver and I don't know how to code, I'm going to lose my job. It was a scary message. But now, in a post-COVID world, where you can think 2 years ago, no one used QR codes, no one used Zoom, no one used cashless payments. Now all this stuff is ubiquitous, and people have realised that adopting new technologies is not just a way of making your business more productive, but it can also be a way of making your life easier and your life better. And so there's a new level of acceptance and comfort with digital technologies in their lives. Now, we have to make sure that we don't leave anybody behind. So digital inclusion is a really important aspect to that, but at the same time, this is the way that the world is moving, and we need to make sure that Australia is at the forefront. And that's why we've said, as part of the digital economy strategy, that our objective is for Australia to be a top 10 digital economy by 2030.
We've certainly seen that intimidation in our business. So I think when I started Stockspot many years ago, the idea of robo-advice or some sort of robot managing your money was very intimidating, and most of the questions we got were around the technology aspect of our business. But we've seen the same acceptance over many years, and once people are using QR codes or a technology for a period of time, they become more comfortable, just like e-commerce back in the early 2000s. I know a lot of people were scared of doing online shopping and using online banks. Now it's probably just my grandma and a few others that don't do that stuff and still visit the branch.
It's incredible when you think about the productivity gains that can be gained from even minor changes to your technology uptake or your digital uptake. The best example, I think, is e-invoicing. If you changed all of the 1.2 billion transactions in Australia each year that use a traditional invoice and change them all into an e-invoice, you'd save $20 per transaction. Now that's a productivity gain.
Is that the speed of things getting paid, or is it?
And it reduces payment times too, so it makes businesses far more viable. It would really change things up in, say, construction. I think this is a really exciting development and something that Australians will embrace.
Senator Hume, if you're re-elected, what will you aim to achieve in your next term?
Chris, there are two things that I'm really excited about in the next term. One is the digital economy strategy. We've put so much effort into those foundation stone investments, things like NBN, 5G and 6G readiness, cybersecurity investments, the Job Trainer Fund, the new payments platform, and of course the consumer data right, and how those apply to those, those technologies that we've identified. Internet of Things, quantum computing, AI, blockchain technology and advanced data analytics, and then how they apply to the different areas, small businesses, small medium enterprises, existing industries, and of course new industries as well. Taking us to being a leading digital economy in society by 2030, a top 10 digital economy in society by 2030, I think is really exciting. For me personally though, the consumer data right is where I am most excited. This was a brainchild of Scott Morrison when he was Treasurer. He went to the UK, he saw open banking in operation, he said, I want me some of that, but I want to make it even bigger, and not just have to apply to open banking, but also to other sectors of the economy, whether it be energy and telecommunications, superannuation, insurance, non-bank lenders, and the sky's really the limit with consumer data right. And this will allow people to access data about them that these big companies hold. And they use it for their own benefit now. They monetize it. But this puts the consumer back in the driver's seat. So I can right now take my banking data from my bank, whether it be my transaction histories or what products I hold, what interest rates I pay, and all of my consumption data as well. I can take all of that and safely and securely, with full consents, share it with a third-party provider who can give me a better deal. So this is going to change up the way that we deal with not just financial services, but all sorts of products as well. It will reduce prices and it will increase competition, and it puts the consumer right at the centre of those decisions. It really empowers the individual, which of course is so very liberal in its thinking. So that's what I'm most excited about for the next term of government.
And there certainly seems like there's big opportunities in super to make information more easily accessible and, like you say, usable for people to make better decisions.
Well, that's exactly right. Imagine how we could use the consumer data right, for instance, combine that with a retirement income covenant to create bespoke retirement income products for the individual at just the right cost, but also taking into account things like their longevity risk, their inflation risk, investment risk, but also the flexibility that they need to draw down money when they need it the most. I think this is a really exciting development, and I'm looking forward to it happening in the next few years.
Senator Hume, thank you very much for taking the time to speak with me this morning, and best of luck with the rest of the campaign.
Thanks, Chris.